All right. Good afternoon. Good afternoon. I've not done one of these for a while. We're going to do a bit of a live coverage of the Bank of England interest rate decision today. I don't know what they're going to do, to be honest. I would have thought, given the way things are right now, inflation at 3.6%, target being 2, so we're over the inflation target, that they would stick today on the interest rates, i.e. no increases, no decreases, just keep it as it is. But there has been a lot of headlines talking about the fact that they might actually reduce the bank rate today. So very, very interesting to see what Andrew Bailey and what the vote is going to be. But yeah, this is where we are right now. So let's just have a little, I guess, live discussion around what this looks like, and we'll see how this goes. I might put a poll up in a moment. I just need to change a couple of things, so bear me 1 second, guys. I'm doing this live. I need to change the title of this. Will the Bank of England raise rates? That is the question that we're going to try and seek the answer to this afternoon. Make sure that is saved. I need to turn a couple of things on as well. Thank you so much for joining me as well, by the way. I know that it's obviously 12 noon in the UK, lunchtime and everything. You probably could be doing something a little bit more exciting than listening to me talk about some boring economic stuff. But this stuff is important. It's important for, the financial decisions that we have to make. And obviously it has huge implications for things like mortgages and interest rates on savings. These are all things that, from a financial point of view, we should be paying attention to more in our conversations. Trev, how you doing? Oh, you're saying I'm very, very quiet. Bear me 1 second, see if I can actually fix that. 1 second. How is that, Trev? Is that better? Let me know in the comments. I'll also dial this up as well. Let's have a look. All right, let's go over to the live Sky coverage right now and see what they're saying.
0.25% to 4%. That will be in line with what the markets are expecting. We've seen these 0.25% drops. Just hearing it is a cut to 4%. Interest rates cut to 4%. So that 0.25% fall that we were expecting, the Bank of England has just announced that. So a 4% interest rate has been announced by that Monetary Policy Committee. It's what was expected. We can tell you that our correspondent Gurpreet Narwan is in what is a lock-in down in the basement of the Bank of England, and that's where the Monetary Policy Committee, headed up by the Governor of the Bank of England, Andrew Bailey, explain their reasoning and their rationale to financial journalists. They are then let out, and we'll hear from Gurpreet as soon as we possibly can. But a lot of the time we've been talking about reducing interest rates or changing interest rates. That's been in reaction to inflation. Well, consumer inflation is currently, the Consumer Prices Index is currently at 3.6. Now, that's above the bank's target of 2%. But it's not inflation that's really the key driver at the moment. The thinking is, yes, inflation is too high, but it's actually a weakening labour market and a weakening wider economy that means there's no upward pressure on price growth. And that's kind of encouraging the bank to make these changes. It will also have seen a slowing in the pace of wage rises as well, and will be concerned about a slight increase as well in jobless rates as well, which have been reported in recent months. So like I say, interest rates, the bank's base rate was at 4.25%. It's dropped to 4%. Just to remind you as well, these kind of stories bring about a lot of questions. Scan that big old QR code on your screen right now. We're going to take it through to the Money blog. It will bring you all of your questions. You can submit them there. We'll then bring you all the answers at 2:30. We've got a Q&A panel. It's going to tell you what the interest rate cut means for you, your mortgage, your wallet, and also the UK economy. And can also tell you that later we're going to hear from the Governor of the Bank of England, Andrew Bailey. Like I say, with mortgage rates, it's often the case that banks predict these rate cuts so widely ahead of time that actually they factor in these cuts ahead of time into their mortgage rates. So when you look at the high street banks and what they're offering, they've often taken in the predicted cut into account. So you often don't see major changes to mortgages straight away. It may be not until the next Monetary Policy Committee upcoming that banks start to reimagine or realign their interest rates. So we'll keep a close eye on that. I can also tell you that there's plenty more insight and analysis being pulled together on the Money blog, on the live page, on the Sky News website. And I can tell you that it voted, the Bank of England, to bring interest rates to the lowest level in more than 2 years. It voted to reduce the rate from 4.25 to 4%. That's a level we've not seen actually since March 2023. And like I say, it had widely been predicted by financial markets. It's the third rate cut this year, the fifth since last August. One of the other key things to watch on this is how the Monetary Policy Committee voted and what the split there is. 9 members, 9 voting members, and it's often interesting to see if there's any dissenting voices and what their reasons for dissent were. But we can tell you that they did vote to bring about that cut. And the rate plays a huge role. It helps influence the rates offered by banks and lenders on products, anything from a savings account to a credit card to a mortgage. Borrowers, of course, will be pleased to see that cut. It means that the rate you're going to be charged on your debts could go down. It might not. But if you're a saver, it's not such positive news. It means that you may earn less on your savings. I can tell you, actually, a little bit of movement on the pound against the dollar. Let's just bring you that. The pound has risen versus the euro as well, and the pound has also risen.
Right, let me just pause here quickly and just talk a little bit about some of the commentary they made there. So he mentioned that oftentimes a lot of this stuff is factored in. So this has been circulating that they were going to cut probably for the past week or so. And so on the mortgage side, what you tend to see is the banks are very late to relay on a cut in the Bank of England base rate to consumers because some of it will be priced in, right? Now, for savers, it's very, very different. For savers, typically what you'll see is you'll start to see an interest rate cut instantaneously unless individual banks, building societies, lenders, providers are doing something to, I guess, attract customers, to get more people saving with them. So I think what you'll find if you look at this in retrospect tomorrow is you'll see interest rates on savings come down. Maybe some mortgages will stay where they are, maybe for a few days, maybe a week or so before you start to see any kind of adjustment in there. That's if you're on, now if you are on say like a fixed rate, this really doesn't matter to you unless you're going to be looking to remortgage sometime soon. So you've got a fixed rate coming to an end. So if you've got a fixed rate ending in September or October, this will be good for you because those future rates will be discounted. They will be reduced as a result of this. If you're on a standard variable rate, you should also see an impact as well. Really depending on who your lender is, but go check with the lender to see how quickly they will implement this kind of stuff. What I do think is really interesting and worthwhile kind of like noting though are the reason that they've given here. Like the economy is going to be a big driving factor in this, and whilst inflation is obviously one of the key measures that they often look at when they look at interest rates and what they should do, should they stick, should they twist, should they reduce. At the moment, there's a lot of political arguments for them to reduce the base rate. And the reason for that is because obviously the country is struggling. You know, all the decisions around national insurance contributions for employers last year, that's had a really negative impact. It's why you're seeing the job numbers not be as healthy as they possibly could be. So reducing interest rates essentially means that the borrowing cost for businesses becomes a lot less. That means that they can borrow money, invest into their business. That should in turn then help the economy. So these decisions are being made with multiple factors in mind, oftentimes leaning on a knife edge in terms of is this going to be the right thing or not. What I do think is worthwhile noting is this, though. What happens in terms of the rate of decrease that we might see moving forward? So they've already mentioned there that we've seen 3 rate cuts in 2025. We've seen 5 when we look back into 2024, right? So 5 rate cuts. how quickly are we likely to see rates get to, I don't know, say 3%, for example? I would argue that if we continue to have this equation where inflation is still pretty high and the base rate now being at 4%, at some stage they are going to have to make decisions around, okay, look, so can we continue to, say, do another cut in the next Monetary Policy Committee meeting if inflation is still at 3.6%? That's going to be a real debate. They've done it this time for economic reasons, but can they still stand on those reasons if inflation does not budge, does not come down at the next inflation reading? These are very, very interesting kind of like points to consider, really, to be honest. And like I say, I'm not in the Monetary Policy Committee. It would be interesting to see how they voted, how the 9 members voted. But let's, whilst I try and find that information out, let's just get back to some of the reporting because I paused it right there. And in the meantime,
risen against the dollar, and the UK's 2-year gilt yield has currently just inched up ever so slightly as well. Let's bring in Andrew Sentence, former member of the Monetary Policy Committee. Good to have you with us. Your reaction to what we've just heard?
Well, I didn't think that the interest rate cut that the MPC has made was justified. And the reason for that is that inflation is going up and is not clearly going to come down to the 2% target. Mm-hmm. So they've already cut interest rates 4 times, and therefore they're going too fast on cutting interest rates. But now they've made this cut, I'm hoping that they won't make further cuts because that's not going to be justified until we see inflation coming down. The most likely scenario, however, for inflation is it's going to go up to over 4%. I don't know what the bank said in its forecast today, but over 4% in the autumn. And it's going to take some time to come down to 2% if it gets there at all.
I'm just going to add a comment to this because I had a meeting this week with one of the arms of the government, and the reason why inflation is going to go up, or at least it's predicted to go up from 3.6 to closer to 4%, is because we're already getting news that at the next energy price cap review, the energy price cap prices are going up again. So that in itself is an inflationary measure. It means that people are going to be paying more for their energy, and ultimately that leaves less money in the pocket. So it's an increase in that set of goods and services. So what he's saying here is absolutely spot on. This is something that I have been hearing on the grapevine as well, that we're going to see inflation tick up through the back end of the year.
That 2% figure, I'm just thinking we've not been at 2% for quite some time now. Is it still an appropriate target for the bank to be measuring against?
Well, it's a target that's being used in many other countries, and we've used it, or some version of it, since 1997 when the MPC was established, which was over 25 years ago. The way I describe it is it's inflation that's so low that it's not really noticeable. If you start getting up into figures like 4 to 5%, which we have been quite recently, people notice that their cost of living is rising, and so they don't regard that as low inflation. So about 2% is really around about the figure which allows people to believe that prices are stable.
Andrew Griffith for the Conservatives on comment earlier today saying that this cut, if it was to come about, which it has, is a sign of weakness, not of strength. Is that what you would agree with, considering the fact that we're seeing these challenges for wage growth and increase also in the joblessness rate as well?
Well, the MPC is certainly responding to signs of economic weakness in terms of both GDP growth and in terms of the jobs market. I think the question for economic policy is whether that is the right thing to do now when inflation is still so high. Their primary objective is to combat inflation. But the fact that inflation is high is also a sign of economic weakness. So there is some strength in those criticisms that actually interest rates are being cut, not because the economy is doing well, but because it's not doing very well at all.
We always talk about what this means for savers and for borrowers. It's fair to say, is it not, that a lot of the banks predict these changes so widely that they will have already made their changes to high street products, and that actually, people with mortgages shouldn't all of a sudden expect to see a big tumble as a result of this. It's probably already been factored into what they were being offered in previous weeks.
That's certainly correct. The mortgage market hinges very much on the 2-year outlook for interest rates. And because this reduction in interest rates was widely anticipated, I don't think it's going to change mortgage prices very much. It's not going to feed through very much into the cost of borrowing for people with ordinary mortgages. But the impact that lower interest rates has on the economy is very complex and goes well beyond the impact on mortgages. So there are all sorts of other factors that the MPC has to take into account when it's cutting interest rates.
MPC, independent of the government of the day, but the impacts and the decisions of the MPC will have an impact on the government of the day. And there was only a report yesterday by one think tank that suggested the Chancellor, Rachel Reeves, would have a somewhere around £41 billion shortfall to try and make up in the autumn statement in the budget that's coming in a matter of weeks. What would this mean for the Chancellor? What would she take away from this? And what might the government response be in due course?
Well, the Chancellor will probably put a positive gloss on the fact that the bank has cut interest rates and show that it reflects confidence in her economic policy, but I'm not sure that's going to be quite right. As the National Institute pointed out yesterday, we're heading for a deficit of 40 to 50 billion pounds on the measure that the government puts the most focus on. And so that deficit is something that the Chancellor is going to have to address in some way, either by reining back on public spending, which has gone up an awful lot over the last year or so, or through tax increases.
Joining us live here on Sky News, Andrew Sentence, a former external member of the Monetary Policy Committee of the Bank of England. Appreciated. Thank you. And just a little bit of extra information. I can also tell you that consumer prices index inflation, we were just talking about that with Andrew there, forecast to peak at 4% in September, up from a previous 3.5%, set to be higher than previously thought over the next 2 years as well. That's further information from the Bank of England. I can also tell you that the Chancellor is responding. Rachel Reeves saying this fifth interest rate cut since the election is welcome news, helping bring down the cost of mortgages and loans for families and businesses. The stability the government, as she's referring to there, have brought to public finances through our plan for change.
Oh my God, how disgusting is that? Look, let me just go full screen quickly. So this is where we get into the arena of framing and the arena of political theatre. So we've just heard that inflation is higher than the target of 2%. We've just heard that inflation is set to peak at 4% through the back end of this year. Yet you've got the Chancellor coming out with a political spin of this rate cut is reflective of our plan to get things back on track, or yada, yada, yada. I mean, if we look at it objectively, and I've not said this, the experts have said this, the Bank of England's role primarily is to look at inflation and try to get inflation down to its target. If we look at it objectively, inflation is not at its target. It's 3.6%. It's going to be double by the end of this year. Yet, they have introduced a cut to the rates because of the economic mess that we're in. I can't see how that is as a result of any positive government policy. I mean, look, the Bank of England is an independent entity, and it's supposed to be making decisions independent of the situation, number 10, number 11, so on and so forth. But if you are a conspiracy theorist or you think this way, you'll think, well, actually, how much pressure was Andrew and the MPC members under to cut rates today to kind of help with the economic situation, like I've already explained, bringing down the cost of borrowing, so on and so forth. We've already heard here, because this has been signposted for some time, that it is unlikely that mortgages are going to move in the immediate sense. So when we step back from all of this, what are the genuine chances that people on mortgages are going to be better off at this point? Probably not. What we do know is that savers are going to be definitely worse off immediately. I would love to see the voting record. I've been trying to find this, but it's not yet published. Out of the 9 MPC members, how did they vote in today's announcement in terms of who went for, who voted for them to rate cut, and how many of them actually voted to stick? Because again, if I'm looking at it purely from the objective of you're supposed to be looking at monitoring inflation and you don't want interest, you need interest rates as a lever to kind of control that or to at least influence it. If I was on the MPC, I would have voted to stick today. But at the moment, I'm just looking at the updated website. There is absolutely nothing around their record of who's voted so far. Anyway, let's get back to this and see what other analysis they're bringing out.
Has helped make this possible and helped us become the fastest growing economy in the G7 in the first quarter of this year. We're locking in this growth in the long run by investing £113 billion in infrastructure, securing 3 major trade deals and embracing the technologies of the future to drive up wages and improve living standards across the UK. Response there from the Chancellor. Well, let's bring in our business and economics correspondent, Gurpreet Narwan, who joins us live now. And Gurpreet, we just heard there from Andrew Sentence, who said, look, the Chancellor's going to put a positive spin on it, but there are underlying deep issues that the Bank of England was most likely responding to.
Yeah, and I think food price inflation is one of those. I'll get into that in a minute because it was one of the more interesting aspects that came out of the monetary policy report, which the bank publishes alongside its rate decision. But firstly, I'll just run through the headlines for those who are just joining us. The Bank of England has cut interest rates for the 5th time in a year. So for the 5th time since it began cutting rates in August last year, taking the base rate from 4.25% to 4%. Now, that was a widely expected move.
If you've not already smashed the like button, please don't forget to do so. Just means other people get to see this as well. Thank you.
But what is really interesting is the policy rift that's emerging on the bank. Well, that has been emerging for a while now, but it was really thrown into sharp relief today because the bank had to vote twice for the first time ever to reach its decision. 4 members of the committee wanted to cut. There are 9 members of the committee, by the way. 4 wanted to cut by 1/4 percentage point. Another 4 didn't want to cut at all. And then 1 member, Alan Taylor, wanted a bigger cut of 1/2 percentage point. In the end, he joined the 1/4 percentage point camp to get a rate cut across the line. But it just shows you how challenging it is.
And that's really important to know. So you've got 9 members and it's a 5-4 vote. 5-4. So you essentially have one person who breaks the tie that gets us into the position now where the bank rate was reduced by 0.25%. And that, like they're saying, these are policy decisions. And typically what you find is that if you look back on the voting history, oftentimes there is an overwhelming vote for a particular action they go to. The fact that this was pretty much down the middle with one person as a tie break is just absolutely incredible. And it just shows how much of a difficult situation we're in right now. I'm just trying to see, actually, where was it? I did download their voting record. I've got it here, but it's not just updated with the decision from today. I'll see if I can actually share this as well. Let me have a look and see if I've got this. 1 second. Actually, no, it's updated with the decision for today. So let me just see if I can share this with you guys. This might take me a while just to get up because I have to navigate a few screens here. How am I best going to be able to do this? Right, let's play this clip and I'll find a way of doing this in the background.
It is for policymakers to navigate the current economic climate, how challenging it is to calibrate the correct policy response. Because on the one hand, you've got the economy stagnating, although the bank today did say that there's a bit of greater clarity now on the back of some of the trade deals that Donald Trump has signed, so some of that tariff uncertainty has receded. But unemployment is also rising. Since the Chancellor's national insurance contribution increases have come into force over the past 5 months, we've seen the number of payrolled employees drop. And actually one member, Alan Taylor, the one who voted for a bigger cut, said he was worried about a recession as well. So there are some of the kind of growth side fears that are weighing on policymakers. But then at the other side of all of this is inflation. Now, the bank today upgraded its inflation forecast. It said that inflation would peak at 4% in September. That was up from a previous estimate of 3.75%. Now, it pointed to a range of explanations. It talks about utility bills going up. We know that council tax is going up. We know that water bills have been going up. But it also talked about food, and food is playing a big role here. It said that food price inflation could hit 5.5% later this year. Then it would drag the overall inflation rate higher. And bearing in mind that about 11% of what households consume goes on food, it means that it could play an outsized impact on our perceptions of how high inflation is. That means people will go back to their employers, ask for greater pay rises, and that could create something called second round effects, causing inflation to climb even higher. Now, in explaining why food prices are going up, and this probably isn't news to people who have done in a supermarket shop recently, the bank said that, well, part of it is what's going on in the climate, poor harvests, bad weather. There are also some changes in packaging regulations which are pushing food prices higher. But a big one is also employment costs, increases in national insurance contributions, increases in the national minimum wage, which are affecting food retailers and employers. And so while the bank doesn't like to get too political, likes to keep its language neutral, this won't be good news for Rachel Reeves.
Gurpreet joining us live from the city. Thank you so much. Just a reminder that breaking news this hour, the bank's rate has been cut to 4%, down from 4.25%, widely expected. But if you scan the QR code appearing on your screen right now, you can take yourselves through to our Money blog. You can submit your questions.
Just a few comments on what they mentioned there, right? So the whole national insurance contribution increase in employers that she announced the last time. I mean, that was supposed to be a way for them not to break their party manifesto in terms of increasing taxes on working people. But the impact and the consequence has impacted working people. And, you know, when you start looking at the fact that you've got inflation in all these different baskets, energy, right, food, fuel, what they try to do is give an overview of the basket and then say, you know, this is the general rate. And the truth is, inflation is going to be felt differently by different people, depending on your level of income, depending on your disposable income, depending on how much of your income you allocate to different things. So for some person may think actually food has gone up by, 2%. Well, actually for another person in a completely different situation, food has gone up by 5% if that's where the majority of their spend happens. And this is a difficulty sometimes when we report on inflation in the way that we do, in the fact that it does take an bird's eye view of the situation. It never gets down into the nitty gritty. And the fact that now we're in a situation where, you have these decisions being made and the need for political spin to happen, and we have a Bank of England almost undecided. There's a riff in how they're making decisions. I can't show you the voting record here, but I have got it up here. It's typically a spreadsheet. And if you go onto the Bank of England website, you'll be able to download this in one of the corners, in the left-hand corner of it. But so the vote today, this is to cut to 4%. So you have got Andrew Bailey, he voted to cut to 4%. You have Sarah Breeden, voted to cut to 4%. You have Sawati Dhingra, voted to cut to 4%. Then you had Megan Green, who decided, well, actually, we're going to vote to keep it at 4.25%. You had Claire Lombardelli, 4.25%. Catherine Mann, 4.25%. Then you had Hugh Pill, 4.25%. Dave Ramsden, 4%. So 5-4, ultimately. If you compare that to the last vote, which was in June. Actually, did I just read you the June numbers? So sorry, those were the June. No. Sorry. I'm looking at the spreadsheet and it's all just jumbled. So those were the numbers for this current one. If you go back to the June vote, where the bank rate was 4.25%. And bearing in mind, they held the last time. So pretty much, if we have a look at it, 1, 2, 3, 4, 5, 6. 6 of them voted to pause and hold at 4.25% the last time. 3 of them decided to vote for a decrease to 4%. So we're going from 6 being against a cut, stick, they won, to 3, to now 5 to 4. There's definitely, I would argue, a very different set of opinions on the Monetary Policy Committee around the decision today to cut to 4%. It's really interesting. I mean, I think ultimately what everyone's going to be mindful of now is the next energy price cap announcement, for sure. The next inflation read is also going to be very, very interesting as well, for sure. But if inflation is going to keep going and the cost of living is going to keep increasing through the back end of this year, the only thing that's going to happen is families are going to be squeezed more. They're going to have less disposable income. We're hoping that hopefully by them cutting by 0.25%, there's some kind of impact in the business space in terms of investment into business. Hopefully that then trickles down into just general people on the street. We're not going to know until we see the numbers come through ultimately, but hopefully there's going to be some positive impact of some kind. Let me just get to your comments, because I know that in the chat, just looking at this, there is conversation going on. So let me see if I can just attend to you guys a little bit here. Bear me 1 second while I get to the top of this. Isaac is saying here, I should do a conversation with Gary Stevenson, especially on which assets to bet on rising. Really liked your defense of him and dismantling Dan Priestley's hustle, big bro, grifter nonsense. I actually spoke with, when did I speak to Gary on the phone? We're exchanging some texts, I think it was about 2 or 3 weeks ago. He's a really busy guy. I have been meaning to go back to him to say, look, because what I want to know is I want to know what his take is on the fact that we've got the autumn budget, or the autumn statement coming soon, and everything is pointing towards more tax rises. In fact, I don't know how they're not going to raise taxes. They've been talking about a wealth tax, which I've obviously covered here on the channel, but there is a huge reticence, to say the least, to introduce a meaningful wealth tax that would target the right number of people in society, I would argue. So there's that conversation. I'd love to know what his take on that would actually be, because when you look at some of the economists, the very, very popular economists, they are all saying we need to introduce some form of wealth tax, or we need to increase taxes. Now, their manifesto promise is not to increase national insurance contributions, income tax, VAT. I don't see how they're not going to. I don't see how they're not going to in the autumn statement. It's £40 billion, I think, is the black hole they need to fill. Where's that money going to come from if they don't tax the largest revenue source for government revenue from the public, which is essentially income tax? How are they going to do that? I have no idea. So I'll love to get his take. I'll keep you posted. I will reach out to him over the next couple of days. We'll see what he's up to. I know he's very, very busy though. Let's have a look and see what other people are saying. Where do you think FTSE will end up? Good morning, sir, to you. Good morning. I would probably expect that the FTSE rallies today, because anything that lowers interest rates and is favourable for business would tend to make the markets rally. We've already seen that the pound has gone up. So I wouldn't be surprised if we see that reflected in the FTSE 100 and the FTSE 250 or the FTSE All-Share altogether as well. Debts all across the board and exploring inflation, rising, soaring asset prices. You have to tax wealth. Best done though, a land value tax, in my opinion. Just lowering rates on its own is stupid. Yeah, I think they're going to have to do something, because they're pushing themselves into a corner that is not. You're going to find yourself caught between we're already caught between a rock and a hard place already, but I would argue that you're backing yourself into a worse and worse corner the more they refuse to explore that kind of tax. And look, I get it, people will leave. okay, you're going to lose some people, but not everyone will leave. Not everyone will leave. Do they need to do something on the corporate side? And this is the difficult thing. We talk about profit sharing, right? Profit shifting. Companies like, the Amazons of this world, they will sell in the UK, they'll shift profits over to Luxembourg, for example. That needs to be stopped. But then on the flip side to that, and Apple do this as well, but on the flip side to that, you then have Trump and that party saying, well, if you do anything that means that, effectively Apple has to pay more tax, therefore not delivering as much value to the shareholders, the investors in Apple, then we're going to leverage trade deal opportunities. It's a very, very difficult situation and a very difficult, I guess, circle to complete, because you've got all of these external factors. We know that certain things need to be done, but at what cost? And I think that is the difficulty at the moment that the guys in the Treasury, Rachel Reeves, everyone is going to be confronted with, is if we do this, what's the trade-off? What do we have to give up? What do we need to compromise on in some way, shape or form? Because I understand, look, I am a pragmatic, I like to be pragmatic a lot of the time. You just can't make these decisions without looking at the entire picture. So how they're going to come to a decision on this, I don't know. We'll have to see. We'll have to wait and see. But doesn't this mean that the economy is going to end up over-financialized and running on fairy dust if this keeps up? I mean, technically speaking, yes. I mean, look, the fact that we've got a huge national debt anyway, the fact that we can effectively just keep printing money, I mean, the same can be said for the US. This is wholly unsustainable. If this was personal finance, you're bankrupt a long, long time ago. But in the case of the government, we have the ability to just print money where we need to. And you've got all of these economic levers to be able to make it seem as though it's all okay. And in actual fact, it's not. I mean, if you've got a truly fiscal responsible head on your shoulders, you'll know that this is not in any way, shape or form what you would expect fiscal responsibility to look like. But these are the cards that were dealt, and to a certain extent, I think that there's fundamentally just an issue with having this kind of conversation openly. Because what politician wants to say, these are the huge problems we're facing, this is what needs to be done? Like, you've got to remember, these guys are in office for, 5 years? I mean, there's a reason why Trump wants to run a third term. And I don't like Trump. I don't support Trump in any way, shape or form. But the reason why he wants to run for a third term is to ensure that anything that he implements now is not going to be undone by the Democrats if they win the next election cycle. You can change governments, but you can't change policy. But this is democracy for you, right? Whereas you would argue in other places, in other countries, you may not necessarily be able to change leaders, but you can make tangible change for policy for the benefit of the people. And that's another conversation on its own. And I guess where we are at the moment in the West, in developed economies like ours, we're getting to the point where we're starting to stare that down the face. Like, how do we make tangible change? Lasting, tangible change. Everything feels broken, unfortunately. And who's going to fix it? I don't think there is enough honesty in the political space, and certainly in the public domain, for us to have that honest conversation. I mean, there's a lot of stuff talking about reform right now. What would reform do differently? I see on the channel all the time that this is all down to immigrants and people coming over on boats and how much money has been spent there. Our pension issues and the fact that the state pension is unsustainable, that's been brewing for decades. And it's been known for decades. It's not the fault of the people coming over on boats right now, holed up in hotels. We're very, very easy to point the finger at somebody else without really pointing the finger at the government that has allowed this to happen. And the incompetencies in various governments over the past 15 to 20 years that have got us to this point. But politicians are very, very good at saying, don't worry about all of this stuff, this mismanagement that's happened over the past 2 decades. This is who to blame. And I just don't think that's right. And I think as a society, we need to be a little more awake to a lot of this stuff, because unfortunately, I don't feel like we are. Easy to point the finger. As you're just saying here, they're encouraging more debt and asset prices to soar even more because it's cheaper to take out mortgages and loans now. Yeah, 100%. I mean, the property market, there's a lot of wealth in the property market, right? So you wouldn't necessarily want the property market crashing, because what does that do? That wipes people out. That in itself, that's not a good look. So doesn't this mean that the economy is going to end up over? Yeah, I think we've already covered that one. So let me just see where I am. Someone just saying, Francis is saying here, I think they'll raise taxes on everyone, especially middle income earners. Listen, if that doesn't happen in the autumn statement, I will be extremely surprised. And I think this is going to be a shock for people because, yeah, the thing is, raising taxes with high inflation is just it's a horrible combination because people are already being squeezed. So people are being squeezed from the increase in food, energy, fuel costs, right? People are being squeezed there, and then you're going to tax them more. So the disposable income that they had is going to shrink whilst they're paying even more. It's going to be extremely painful for a lot of people. And I talk about, obviously, having emergency funds and making sure that you have financial structures in place. That's the core of this channel, fundamentally, and understanding how to then, from a point of in a position of strength, be able to invest in the markets. Disposable income for investing is going out the window. There was a report a couple of weeks ago, 45% of working people aren't paying into a workplace pension. Why? Because they're struggling with the cost of living. They need the extra cash. How did we get here? How did we get here? Good conversation going here. Big internet companies like Amazon, Netflix are avoiding corporate tax. 75 billion over the last 5 years dodged. This is what I talk about, profit shifting. But, the likes of Amazon, Apple, these American companies, they've got the ear of Donald Trump. And Trump has been very, very, vocal in the fact that if you do anything to change the tax position of an Apple, the trade deal that you're looking for is going to be under jeopardy. So again, what do you do? Difficult. Very, very difficult. Not sure if you're aware, but your camera is dropping frames all the time. Yeah, my apologies on this. I can see the error here, but I cannot fix it because I'm filming in 4K right now. So I don't know whether or not this was, it was set up for 4K, but there's something going on in the background. So my apologies, I didn't see the error, and I tested this before I came live. Didn't see the error till it's live, and I can't fix it whilst I'm actually live here. I've had a look into it whilst the commentary was running in the background. Hopefully you can hear me though. All good. All right, guys. I think we've covered quite a bit here in terms of just commentary and coverage. What can you do? I mean, look, I think ultimately at the end of the day, you've got to really think about how you strengthen your own position, control what you can control. These things and these decisions are always outside of our influence now that they're in. I mean, we've given them the power to do what they need to do. I wouldn't say this is where we blindly trust them, but ultimately we're kind of like along for the ride now. We're passengers. So the only thing we can do is kind of make sure that we look after our own in the best ways that we possibly can. That's always going to be my message on the channel. Again, if you've not already smashed the like button, there's about 88 of us on here at the moment. There's 20 likes. If we can get that up to 50, that would be amazing. The reason why I ask, and I know it can be annoying sometimes, is because after the live is done, the like rate is just an indication that you've actually enjoyed it. And after the live is done, this will then get recommended to other people who might be looking for this news today on YouTube. And it just means that they will get to see it and other people will get to see it. More people will get to see it. And that also helps me out on the channel as well. I might do a live on Sunday, maybe a Q&A, perhaps on Sunday evening. I'll see about that. But thank you so much for joining me for this one. I really do appreciate your time. When is the next meeting? The next meeting, I need to look at the dates. When is the next meeting? Let me have a look. 1 second. When is the next one? When is the next rate decision? There isn't a date announced, I don't think, right now. Not that I can see online. It will probably be sometime in October, I think. Because we're in August right now, I would imagine it's going to be sometime in October will be the next interest rate decision. At that point, I would definitely expect them to hold for sure. Because if they reduce at that point, there will be a lot for them to answer for. So I would say they would need to hold at that point. Thank you for smashing the like button, guys. Appreciate you so much. Yeah, if I don't see you on Sunday, I'll definitely see you on the video next week. But I appreciate all the engagement on the channel so far and the conversation we're having at the moment. The demographic has shifted slightly on the channel. I've seen it shift massively. So with that in mind, I'm looking to make more content that will be relevant to those guys, to the people who are now watching the channel, which is 45 plus, generally speaking. So it will be more kind of like news coverage as I see it. The reason why I do it in that fashion is not to take political sides, but to try and make sense of what's going on. So for example, in the video on Tuesday, we talked about the fact that the state pension age is likely going to be brought forward from 2024 to 2039. I mean, people are going to be impacted by that effectively. So within these conversations, what can you do? What are the things that are within your realm of your control that you can influence? Those are the type of things I want to be able to pull out. And it's also to try and make sure that we can have really good conversations and discussions as well. So stay tuned for more, but I appreciate you. Thank you so much for watching. And I'll catch you, if not on Sunday, next week sometime, on Tuesday. Cheers.